Hello everyone, my name is Adam Livingston. I am the Bitcoin Wizard. Get ready for today. We're talking strategy versus Nvidia. That's right. Bitcoin versus AI. What is the best stock to buy going into this next decade of technological transformation? Now, that said, this is not financial advice. This is financial entertainment. Please consult your stupid financial advisor for his opinion before you gamble your life away on an assets that won't beat shadow inflation. Picture Michael Saylor in one corner spinning scarcity spells while Mr. Jensen paces in the other flinging silicon. My job is to call this fight fairly, maybe toss in a few jabs of humor, and make sure nobody confuses marketing smoke for monetary fire. Visualize two skyscrapers on the same boulevard. Strategy's tower is 26 stories of solid Bitcoin bullion, capped by a modest penthouse of equity premium. Nvidia's tower is 90 glass floors of future earnings projections, balanced on a lobby made of IOUs and Taiwanese silicon. One gust of macro wind, monetary, geopolitical, or regulatory, and which building do you think rattles first? That's right, let's get into it. So Strategy's market value right now hovers around $95 billion, yet roughly $72 billion of that is hard Bitcoin that you can verify on-chain right now. Investors are paying a premium to the underlying BTC, about 54%. Meanwhile, Nvidia is carrying a $4.1 trillion market cap, trading at about 50x their trailing earnings. That's right, and nearly 25x the sales. A perfection premium that Wall Street hasn't awarded a chip maker since the dot-com era. So what does that mean in plain English? You know, the difference between these two multiples. Buying Strategy right now is like paying $1.54 for a dollar bill that gains scarcity every 10 minutes. Buying Nvidia is like handing over $50 for a promise the world will never build a cheaper GPU or start a trade war. So that isn't necessarily investing, is it? That's betting the dealer never shuffles the deck. So let's move from raw valuation to the fault lines that nobody models until they crack. I call this my structural risk audit, and here's how it breaks down. Number one, first is the currency exposure. Strategy's treasury is 100% Bitcoin. It doesn't care if the dollar prints $1 trillion or 10 trillion because the supply of Bitcoin never budges. Nvidia, on the other hand, parks 20+ billion in cash that melts at 7% CPI or probably 12% monetary shadow inflation. Roughly $1.6 billion in real value being vaporized every single year. Owning Strategy is riding a lifeboat that rises with the monetary tide, and owning Nvidia means bailing water faster and faster, hoping the Fed eventually tightens. The second item in my structural risk audit is counterparty concentration. Strategy's coins live in multi-sig cold storage. No bank gatekeeper, no bail-in risk. Nvidia, for all of its silicon swagger, is single-threaded to TSMC. One earthquake in Taiwan or a Taiwan Strait blockade and 90% of its supply chain evaporates. Which risk feels easier to hedge, a cryptographic key or a geopolitical flashpoint? Third is regulatory fragility. Bitcoin's legal status is marching toward commodity levels of clarity. FASB's fair value rule now lets Strategy book the upside without impairment landmines. Nvidia, meanwhile, dances inside an export minefield. Washington now skims 15% of its China AI sales and forces it to ship lobotomized GPUs to comply. One executive order and an entire revenue stream turns to dust. Fourth is demand cyclicality. Bitcoin's network has grown every year for 16 straight years. Bear markets just add wallets. AI accelerators, by contrast, ride hyperscaler CapEx cycles. When Amazon or Google finish this build-out, GPU orders can fall off a cliff the way crypto miner ASICs did in 2018. Strategy's demand curve is mathematically programmed. Nvidia's is CFO approved until the next cost-cutting memo. Finally, supply chain paralysis versus digital resilience. Strategy's asset, Bitcoin, lives on thousands of nodes worldwide. To shut it down, you literally have to turn off the entire internet. Do you see that happening? I don't think I do. Nvidia's asset lives on wafers that need water, neon gas, and a stable Pacific Ocean. The more you think like an insurance underwriter, the louder the asymmetry screams. So ask yourself, when the next left field event hits, currency shock, cyber breach, or a destroyer drifting too close to Taiwan, do you want your portfolio's core bet tied to physical choke points and central bank whimsy, or secured by math, scarcity, and global redundancy? That is why strategy isn't just the cheaper ticker here, folks. It is the structurally safer skyscraper built on bedrock that most investors still mistake for sand. Let's talk catalysts, because a cheap stock that never re-rates is just a value trap. Strategy has a fuse box stuffed with near-term sparks and long-term rocket boosters. While Nvidia's schedule is mostly, yeah, AI is cool, but let's just hope nothing ever goes wrong. So obviously, ignoring the fact that Bitcoin is going to go up forever, Laura, that's correct, because the value of stocks are most likely denominated in fiat, and fiat is designed to go up forever in perpetuity because that's what the money printer does. When you denominate the value of Bitcoin in USD, therefore number go up on Bitcoin forever. Do you get it? On top of that, catalyst number one is FASB fair value accounting. That's right, until this year, GAAP forced companies to book only Bitcoin impairments, but never the markups of the Bitcoin price appreciation. So as you continue to see the hundreds and soon to be thousands and soon to be tens of thousands companies buying Bitcoin and putting it on their balance sheets, you will see every single uptick become GAAP income. EPS volatility is going to flatten, and analysts suddenly have to model upward surprises. Catalyst number two is the potential S&P 500 admission. Once those GAAP numbers stabilize, maybe a second quarter of insane profitability, strategy will finally clear the profitability hurdle that kept it out of the index. Passive inflows are going to do the heavy lifting, and a single inclusion day one will pull billions of forced buys. I've been saying this a lot on X lately, but can you imagine the weighting that strategy will have in the S&P when it has 800,000 Bitcoin and Bitcoin is above $200,000? That's right, we're talking numbers on the scale of $30 billion, $40 billion, $50 billion, depending on the Bitcoin price, of passive buying going into strategy, which Michael Saylor will then just hammer the ATM on the common stock to buy more Bitcoin, reinforcing the flywheel. Then the weighting gets higher, Michael Saylor buys more Bitcoin, yada, yada, yada. And that contributes to catalyst number three, the relentless stacking. Just last week, strategy added another 1,955 more coins every quarter. The float of Bitcoin shrinks and the asset floor rises, compounding the net asset value time and time again. So if you shift to the medium and the long term, the next Bitcoin halving is in April 2028, which is instantly going to cut the new supply of Bitcoin in half. So think of it as a scheduled share buyback, no board vote required. Sovereigns and CFOs integrating Bitcoin into their reserves are going to create a reflexive demand loop for the asset itself. Strategy stack is going to work like a perpetual buyback. The scarcity is going to drive the price. Each price boosts the MNAV, and fresh equity lets them buy even more. It is beautiful. It is the greatest feat of modern financial engineering in history. And when you add the statutory clarity coming, the regulatory overhang vanishes. Right as institutions get the green light, you see banks getting the approval to custody Bitcoin again. So when you talk about strategy versus Nvidia, okay, one firm is waiting for regulators to loosen shackles. The other is praying regulators don't tighten them further. Bottom line, if strategy's catalysts are hard-coded, reflexive, and largely within its own control, Nvidia's are geopolitical, cyclical, and priced to perfection. When you stack the spark plugs side by side, you realize that only one engine is guaranteed to fire, and that is Michael Saylor's love child. So time to put some hard numbers behind my totally unbiased rhetoric. Think of this slide as a 10-year war game with three possible realities. Scenario 1, Bitcoin grows at a modest 25% a year, barely one quarter of its historical 92% decade-long compound annual growth rate. Strategy's 638,000 coin stack compounds from $72 billion to $663 billion. If you slap on a very modest multiple, you're looking looking at an $862 billion market cap, an 8-bagger that delivers roughly 21% internal rate of return to shareholders, even if Strategy never writes a new line of software code. So meanwhile, for Nvidia to match about half of that IRR, over the same period it must thread a heroic needle, sustain 18% annual revenue growth, keep growth margins north of 70%, and somehow hold its forward PE ratio above 35 in perpetuity. That assumes no Taiwan shock, no export clampdown, zero credible competition from AMD, Intel, or some hyperscaler rolling its own ASIC. The minute any one of those dominoes wobbles, the IRR collapses. So scenario 2, Bitcoin chills at a 15% CAGR, which is extremely realistic. I'm of the opinion that Bitcoin will end up at around 30% over the next decade. But that said, let's just cut that in half for fun. Strategy's net asset value still to $287 billion with a market cap of about $373 billion, and shareholders pocket a 13% IRR. For Nvidia to keep pace, it must grow its top line faster than the entire smartphone boom and pray their multiple compression halts at 25x earnings. Just a heads up, history suggests that praying is not a strategy. Scenario 3, Bitcoin is flat for 5 years. That's correct, flat for the next 5 years, and then a subdued 10% run rate. Strategy treads water, then accelerates, ending the decade with a low double-digit total return. Call it a savings bond on steroids. Nvidia, under that macro, would see hyperscaler CapEx plateau, margins start to mean revert, and valuation compress, the best case low single-digit IRR. Let's be real. The worst case, negative. So the punchline is brutal in its simplicity. Strategy's downside is bounded by mathematically enforced scarcity. Nvidia's upside is bound by a perfection premium that markets rarely forgive. So for some reason, unless you believe that Fiat strengthens and trade wars vanish and Moore's law becomes Jensen's law forever, the probability-weighted math crowns Strategy the runaway favorite. Now let's flip the binoculars around and examine where Wall Street's pricing engine goes spectacularly blind, and what I call the mispriced-risk lens. Hidden tail risk number 1 is monetary debasement. Nvidia is flaunting a $24 billion cash hoard, but at today's 7% CPI, that pile, remember, is losing $1.6 billion of real value annually. Strategy converts that drag into rocket fuel because every uptick in the money supply historically pushes Bitcoin's purchasing power higher, lifting Strategy's net asset value without the board lifting a finger. Without selling a single product. You can fight the Fed or you can invoice the Fed. Strategy has chosen the latter. Hidden tail risk number 2 is geopolitical single point failure. So Nvidia's value chain begins and ends on an island 90 miles from the Chinese mainland. A blockade, an earthquake, or even a water rationing mandate at TSMC, and the supply tap shuts off. Strategy's assets lives on a global mesh network. To confiscate it, you'd need to unplug the entire internet and every satellite connection. One thesis is a bit ridiculous, the other is a bit mathematically guaranteed. Hidden tail risk number 3 is regulation by tweet. Nvidia's export density hangs on the next 280 character policy grenade that is written by Donald Trump. A single US commerce memo also can now tax 15% of China AI sales and force downgraded silicon into the world's biggest data center market. Meanwhile, Bitcoin has never been more partisan. I even think the Democrats are starting to give in just a little bit. Republicans are now calling it liberty tech. Maybe Democrats will start to frame it as financial inclusion. And remember, FASB just blessed fair value accounting. Strategy's regulatory risk curve points down as adoption rises. Nvidia's will point up with every Senate hearing. And here's a fourth one off the top of my head. Remember the demand cyclicality masquerading as secular growth? Remember, we're just assuming that the CFOs of these big tech companies will never pivot to optimization mode. Bitcoin network demand, by contrast, grows with every block regardless of a business cycle. Strategy's core asset does not care if Alphabet delays a server refresh. It cares only that the next block arrives in roughly 10 minutes. Oh, and by the way, for the people that are going to say Google uses Tensor chips chips. Yeah, I know, calm down, it's an example. So if you add these tales together, you discover the upside-down world of modern markets. The company, priced as risky, Strategy owns the anti-fragile asset, while the company, priced for perfection, Nvidia, sits on 4 loaded dice. Once investors realize that the sensors are pointed the wrong way, the re-rating will be violent and asymmetric in favor of the Bitcoin tower built on bedrock. So let's leave these spreadsheets for a second and talk about the intangible forces that drive multiples higher than any discounted cash flow ever admits: qualitative optionality. Start with the scarcity flywheel. Every single week that Strategy buys Bitcoin, potential whole coiners of Bitcoin just vanish. This is the perpetual motion buyback machine in reverse. There's a reason why Strategy has been the best performing equity over the last 5 years, completely destroying Nvidia. Nvidia's flywheel works kinda the opposite way. It must outspend their rivals just to keep current share. So capitalized research and development is running over $10 billion a year, and the second AMD or a hyperscaler closes the performance gap, that spend climbs even faster. Scarcity flywheel, more like treadmill of diminishing returns. Next is brand narrative. Strategy has morphed into the corporate meme that eats Bitcoin like Pac-Man eats pellets. Wall Street is trying to wrap their head around that Strategy's treasury assets, their product, and their marketing strategy is all one thing: Bitcoin. Bitcoin does their marketing for free. Each on-chain purchase is a press release the crypto world retweets into orbit. Nvidia's brand glow, yes, it's real, but it's dimmed with every sold-out GPU that gamers couldn't buy while the data centers hoarded inventory. Ask a streamer how they feel about $2,000 graphics cards. That's not exactly organic goodwill. And finally is just the capital structure edge. With the capital structure, Strategy has purchased the most amount of business optionality. That's what happens when you, as an individual, buy Bitcoin. You buy more freedom. You buy more future optionality. You pull your potential time value into the present. And when you do that with debt as a publicly traded company, you multiply that force factor 1,000,000 times. When you tally the intangibles, reflexive scarcity, viral narrative, and future low-cost capital, you realize that Strategy's optionality is exponential, while Nvidia's is linear and fiercely contested. Multiples follow stories, and Strategy's story ends with the black hole devouring Fiat. Wall Street has not priced that sequel, but early ticket holders will own the theater. So time to put the referee whistle away and turn on the floodlights here. Here is the risk-adjusted return matrix that the market somehow ignores. So remember, we went over that expected IRR with, in my opinion, an extremely unlikely base case scenario and still a 21% versus the 12% from Nvidia. But if you slide on over to the downside volatility, Strategy's 95% value at risk is about 38%, and Nvidia's 95% VAR comes at 55%. Because one hiccup in Taiwan, one export memo, or one hyperscaler spending pause translates straight into lost shipments and margin shock. And equity beta tells the exact same story. Because of the FASB rules that let Strategy recognize their fair value gains, its trailing beta drops to roughly 0.9 versus the S&P. Nvidia's clocks in at 1.3, and that does not include geopolitical tail risk. Beta never does. So if you put those inputs into any Sharpe ratio calculator, Strategy spits out a 0.73 on historical vol, while Nvidia limps in around 0.35. That means for every unit of risk you accept in Strategy buys you roughly double the excess return you'd get from Nvidia. It's like choosing between a bond that pays you twice the coupon with half the default odds. Only in equity land do investors call the latter best in class. So the matrix is telling us two things loud enough to pop earbuds. One, Strategy offers superior upside even under pessimistic Bitcoin assumptions. Two, it does so with less systemic and market-linked risk because its core asset is uncorrelated scarcity, not a single-threaded supply chain. If you're paid twice as much for taking half the risk and you still pick The lower return, you're not investing, you're collecting lottery tickets and calling them blue chips. So we've poured over hard assets, soft narratives, tail risk landmines, and 10-year Monte Carlo maps. Time to stitch it all together. If you strip away the marketing gloss, every investment choice reduces to two questions. What am I really buying, and how many ways can it break? When you buy strategy, you are acquiring programmable scarcity collateralized by math, with upside that reflexively amplifies whenever fiat policymakers do what they always do: print money. When you buy Nvidia, I'm sorry, but you are just renting perfection. Perpetual node leadership, eternal export waivers, infinite hyperscaler appetites, and geopolitical peace in the Taiwan Strait. History laughs at that shopping list, okay? But strategy owns an asset that behaves like the world's first self-refining uranium, infinitely divisible and already stockpiled on the balance sheet. They already have the money. Nvidia's valuation is based on potential future money. Strategy already has it. The multiple could go to 1 and it would still outperform Nvidia. Nvidia owns an oil rig that's sitting on contested waters with a single supply boat. Risk is not a price tag. It's the probability that you wake up tomorrow to find the game that you were playing has new rules. Strategy's game rules are etched in SHA 256 stone. Nvidia's are scribbled on post-it notes in Washington and Beijing. So here's the verdict. If you crave asymmetric upside and a capital structure that's engineered for turbulence, strategy is the skyscraper built on bedrock and Nvidia is the penthouse built on a trampoline. Investors will eventually price that difference. We have the rare chance to front-run that epiphany. Let's take it. But remember, this is not financial advice. This is financial entertainment. My name is Adam Livingston. I am the Bitcoin Wizard. If you enjoyed this content, please like this video, subscribe to the channel. I bring daily Bitcoin insights during the greatest wealth transfer in the history of humanity. Have a wonderful day and don't party too hard. Class dismissed.